Good afternoon, financial professionals. Tiffany Armour here of E4 Insurance Services, welcoming you to the BREW, building relationships every week. Thanks for tuning in today. For those of you joining the BREW for the first time, welcome. We like to start the BREWcast by celebrating today's National Day for August 4th. Today is National Chocolate Chip Cookie Day. The first chocolate chip cookie was actually made by accident at an inn called the Toll House. In 1938, Ruth Graves Wakefield one day planned on making regular chocolate cookies, but did not have the right ingredients. She ended up using chunks of a chocolate bar instead, leading to the creation of the chocolate chip cookie. So grab a glass of milk and get to dunking away. Today on the BREW, we have John Dallas, CEO, and Peter Spreen, Marketing Director of Berkshire Settlements. Berkshire Settlements is one of the leading life settlement providers in the U.S. They are a direct buyer of life insurance policies from policy owners, helping them maximize the value of policies they no longer need or can afford. Feel free to use the chat box to share your thoughts when John and Peter are live. I'll be keeping an eye out for your questions. Also, all attendees are in a drawing for a prize, and we will be announcing the winners shortly. Thank you for tuning in, and without further ado, John and Peter, welcome. The mic is yours.
Thank you, Tiffany. Appreciate the intro, and good morning and good afternoon to everyone, depending on where you guys are. Thank you guys so much for taking the time. Well, Tiffany kind of took the words out of my mouth, but I'll get started. Yes, we are Berkshire Settlements. My name is Peter, and I'm the Marketing Director for Berkshire Settlements. Today, what we're going to cover in our discussion is what is a life settlement, how life settlements are valued and calculated, who qualifies for a life settlement, and the overview of the life settlement process. A little bit about Berkshire, just kind of what Tiffany had said, but we are a direct buyer in this space. Berkshire has been around since 2004. We've worked with thousands of insureds, owners, agents, very experienced in this space. So just kind of one thing to keep in mind. So kind of the first question I always get is, what is a life settlement? A life settlement is a third party purchasing a life insurance policy from an owner and that no longer needs it or no longer can afford it. It is that simple. Some people try to make it a little bit more complicated. It really isn't. And what has kind of happened in the last, I would say, 10 years, as interest rates have continued to go down, a lot of money has come in this space. So there are a surplus of purchasers and not enough life insurance. So that's what we're here today to kind of help you uncover hidden value in your book of business that you might be able to add value to your clients, along with put a little extra dollars in your practice. So that's the goal. Okay, so who qualifies for a life settlement? That is the million-dollar question I get asked every day. And the easy answer is it depends on the product. But I'll give you some general guidelines to kind of use some framework to start building a case and kind of start identifying prospects within your book of business. First and foremost, senior citizens. Again, depending on the type of product, but a general guideline is males over the age of 75 and females over the age of 79 is when a case starts to develop. This depends again on if it's a UL, whole life, or term, and we'll kind of get into that a little bit later, but this is just general guidelines. Depending on the cost of insurance, these numbers can be lower. So if you have no lapse ULs, males, females that are in their late 60s sometimes do qualify, and we have worked on citizens, senior citizens that are even in their 60s, 65-ish, okay? So just kind of keep that in mind. The next, and this is really the most traditional, this is where our industry started, was terminally ill patients. They are sad cases, of course, but this is a great bridge for when an accelerated death benefit does not work. That is the biggest question I get is, why wouldn't an insured use accelerated death benefit? And at Berkshire, we always encourage the advisor to explore the accelerated death benefit option prior to coming to us for a terminally ill case. But after that bridge has been exhausted, where they don't meet the 12, 24-month window, we meet that bridge where they may have a life expectancy that is anywhere from 7 to 2 years, sometimes less, where it doesn't make sense from the the language within the contract, or the contract doesn't have that. But that is something to kind of keep in mind. Obviously, again, sad cases, but a necessary thing for treatment. And then lastly, chronically ill. Again, these are traditionally going to be your older patients, clients that we're working with. And again, these are just basically offset long-term costs. We see a lot of people that as people are aging, long-term care costs are going up, and loved ones are trying to find ways to fund this. And so this is another way to do so. So that's who qualifies for a life settlement. Again, if there's any questions on that, we can kind of get into the weeds on where the senior citizens, because that is always the biggest question, but we'll discuss that. Okay, next is kind of triggers on when to start a conversation with a client on, okay, this might be a prospect meeting the who qualifies as age-wise or health-wise. Then it's just looking at general things and market changes within the world. These are definite things that we look at. So first and foremost, estate and tax laws. Estate and tax laws are constantly changing. Many are expecting those laws to change with this current administration. And if they do, a lot of people are going to be, they're not going to have a need for the current policy that's in their ILET. Great way to kind of start a conversation. Hey, let's look at this asset. Let's try to maximize this. We no longer need this asset, no longer need to move those premiums into the ILET. Beneficiary needs change. We see this a lot. Just the kids are much more successful than they thought. And again, policy is no longer needed. One of the biggest things we see when a trigger starts is, of course, when the insured's health status changes. And it doesn't have to be a drastic change, but as an advisor, you're constantly meeting with your clients on an annual basis, maybe even semi-annual. You're getting a check-in on how their health is, and maybe something changes. Financially, it changes. And at the same time, they're looking for liquidity, great asset to look for, potentially looking at a life settlement. And that kind of goes with the need for liquidity as well. We see this often, financial things change. Great way to, offset that and provide dollars for your clients. And then lastly, product changes. Cost of insurance is going up in these products. You guys have probably seen in some of your blocks of business, certain products, cost of insurance is just becoming unaffordable. And so clients are looking for opportunities to get out from these products. And dwindling surrender values. This is, traditionally when we see most people that don't have huge health changes, they come to us and they say, hey, my surrender value is dwindling. I'm looking to get out from this product. What can we do? So that's kind of when we start looking at an opportunity. Next thing is, how is the value determined? Now, this is always the million-dollar question, going back to what I was saying about the age and then looking at the product. The product is pretty much the largest driver of how value is determined in this marketplace. So what we determine and looking at the three products that we purchase is whole life, term, and UL. A lot of people think, oh, you can't buy a term, can't buy a whole life for one reason or another. It always depends on what those future premiums are. So we look at what are the future cost cash flows of those premiums, depending on whatever the product is, and how much cash value is in the product as well. We run a present value calculation on that, what the current death benefit is, and then we also look at what the insured's health is. With those three things, current cash value, future premiums, and health, and then what the death benefit is, we come up with a present value. That's what this blue bar is representing. With that, that is what the offer is. And that is also determined by the interest rate that they charge, or that we're looking to achieve with that investment. But that is the biggest driver on looking at when the age of the client determines the value of the product. We do see high COI products that you need a much more unhealthy client, or they need to be much older because those premiums get really steep really quickly. Some of the NLG products out there, you'll see a very, very unsteep cost curve right here. So we're able to acquire this for a lot more, or they can be a lot younger. So really bottom line is this: when you're looking at a client that has a product, having a general idea of their health and having an in-force illustration is really the best way to start a case. Because without it, we see so many products out there, from group conversions to COI increases to products that have had guarantee COIs, and the qualification is all over the board. So once you've kind of gotten a case to a point where you think, okay, I might have a prospect, you give us a call. We say, okay, yes, I think we might have a prospect here. Next question is, okay, how does this get done? How do we actually get a deal done from A to Z? So it's the next step. So our process is initial qualification. We'll jump on a call, have the in-force illustration, have a general idea of the general health of the client. Our team will go back, run an evaluation on that in-force illustration, and come back to you and say, hey, this case either is it should work with what you've gotten an idea of the health of the client, or this is probably not going to work. Let's save you some time. That's the biggest component working with a direct buyer. A lot of entities will drag this process out, collect more information, and time is money. That is the goal of our organization, to maximize our advisors' time, is trying to draw out and eliminate unnecessary processes that other groups might think is necessary to get to a no. And a no or a yes is really what you're looking for as quickly as possible. After we determine, okay, we are going to actually move to the next step. The next step would be filling out an application. We have a short form medical questionnaire that the client can fill out, give us a summary of their health, or they can just sign a HIPAA, sign a release of information, and we can go to the carrier, pull medical records, pull the in-force, and run the rest of the evaluation, because some don't have an in-force or don't want to pull an in-force. At that point, we can do everything at that point for you. Medical underwriting, traditionally our process takes about 4 to 5 days once we have medical records or our medical questionnaire. And the policy due diligence at the same time is taking place at the same time, looking at pricing of the policy, what the future premium streams are, and coming together with that present value of that policy. Kind of going back to the previous slide, all of that, all of the ingredients kind of come together into a present value and an offer for your client. And then an offer. And that is the last step from there. Once an offer is accepted, then we go to contracts. The contract process, traditionally from A to Z, is a 2 to 4 week process, depending on the carrier. And that is the biggest X factor. Carrier processing time is always what we struggle with. Some are great, 5 days. Others, you guys deal with them, can be 15 to 20 days. So that's always our largest X factor. So when managing the expectation of your client, and they ask, okay, we're ready to do this, how long is this going to take? It's always dependent on the carrier, but 2 to 4 weeks. And with that, a lot of people ask, what products should we be looking at for, to kind of make this process simpler. And this is really, this is the $1 million question, but traditionally term, you're going to need to be very sick. That's the bottom line. Whole life, you're going to have some impairment due to the high cash value or endowment contract type, but the guaranteed premiums on those are very, very advantageous in the later years. Traditionally in our industry, UL is what people are purchasing. That is probably 85% of our business. So UL, if they have a UL, they've had it past the 2-year portion, they've gotten through the target premium portion as well, that's when there's a potential deal. And with that, that is really it. That is life settlements in a nutshell. So is there any questions or anything I can answer?
Thank you so much, Peter. That was very, very informative. There were a few questions that actually came through. Okay. The first one, how are people protected from the buyer of policies knowing about the insured's private information?
So just understanding when they purchase the policy?
Right. How are they protected? Because, as far as the purchasers the funds and everything that are purchasing these policies. They know everything about them, all of their private information. So how can the insured feel that they are protected, knowing that all of their private information is out there?
Of course. So beyond, there are a lot of HIPAA laws that have to be compliant with all of these companies that handle medical records. All of our, and really, I would say the provider itself, it's who they choose to do business with. So I can't speak for our industry, but I can speak for the groups that Berkshire works with. The funds are really who are going to be looking at this information and holding this information when it's purchased. So working with institutional capital sources, Berkshire only works with institutional capital sources. We don't work with, we call them mom and pop purchasers of life settlements. These are the individuals, not to speak ill of them, but these are the individuals where you might have an issue. But institutional capital sources that are used to dealing with sensitive information, financial, medical information. These are your traditional private equity, pension groups that are purchasing these along with hedge funds, and they are experienced in this. So again, just kind of wrap that up. It's the institutional capital sources that you're dealing with that are used to dealing with this. And they take tremendous steps, because a data leak pretty much kills a business, right? You see a data leak of your information, and all of the trust goes out the window with that. And that's from a investor to an insured who sold their policy. So that kind of hopefully, yeah.
That makes sense.
And a lot of our the entities that are holding the risk, that are the end investors that are not, and our financial partners in these, as Peter said, these are private equity firms, they own insurance companies, they own other consumer financial companies, and they're used to dealing, and they have to deal with this information in a way that is going to allow them to adhere to HIPAA and Gramm-Leach-Bliley and all the other state or federal requirements to keep someone's information protected.
Perfect. Another question that came through. I've heard that people can sell their policy and retain a portion of the death benefit. How does that work? And then is the death benefit out of their estate for estate tax purposes? What are the tax implications on that?
So yes, to answer your first question is there are arrangements where an insured can keep a portion, or an insured or owner can keep a portion of the death benefit. The market is smaller for that, but there is a market for it. With that said, how that comes about is looking at the present value calculation of the policy, and then the fund determines how much retained death benefit can be presented. So it comes on a case-by-case basis. And then on the taxability side,
I can field that one for if you want, Peter. So it's a much more complicated tax question than one might think. A life settlement taxation is very cut and dry. The IRS, just being totally blunt, the IRS has not addressed how a retained benefits transaction would work. But from working with very high-profile tax attorneys on some extremely large transactions that did retain benefits over the years, the overall kind of opinion of these attorneys was that the transaction is taxable. There was not a consensus on how it would be taxable, but the transaction would be taxable in some way, shape, or form. And that's why we always suggest someone consult with their tax professional to get their opinion before entering into one of those transactions. I will say also with those retained benefits transactions, they are great for consumers that need to retain some sort of coverage if they are uninsurable. But one thing to make sure that if you're, when we do retain benefit transactions, the owner or the owner's benefit, the designated beneficiary always stays on the policy as an irrevocable beneficiary of that policy. And that's something, if you're looking at these transactions, something that you want to occur if it's with someone else in our market, that helps protect your client as well too in the future, and makes things easier when you have to make a claim at the inevitable point that someone passes away.
Perfect. One last question that came in. Typically, how many offers are received on your average case, would you say?
Depends on the case, but traditionally in our space, we send it to a number of our financing entities. John could probably speak more to this, but traditionally there's about 4 to 5 that come in, give or take. Would you say, John?
Yes. So we work with several financing partners in these transactions, and they all have different risk profiles. So someone that looks like ABC might not fit for 2 or 3 of the groups, where it's a good fit for a few other of the groups. But we try to get as many offers as we can to drive value for your client, as well as we also know that, hey, people aren't going to sell. Determining this is a value here isn't hard, and we're trying to provide value to you as the agent as well too, so you can give as much money to your client. So we try to do what we can for everyone to end up in a good situation.
Great, thank you so much. Just a reminder, today's Brewcast is being recorded and will be posted on YouTube this afternoon. Check out our BREW blog at e4.insurance for an entire library of content crafted for today's financial professionals. And now for our giveaway. Peter, I'm going to ask you to give me a number between 1 and 15.
Okay. Let's go with 5, please.
Perfect. Let's see. Who is the winner? All right, Danielle, let's see. All right, it looks like the winner today is Edward Bartling. Congratulations. Be on the lookout for a Starbucks gift card and continuing education will be coming your way from all of us here at E4 Insurance Services. Tune in next week for the BREW. Winning referrals from centers of influence like CPAs and attorneys can be a challenge. Zach Schnitzler works as an insurance specialist at a top 25 CPA firm, ranked by the Inside Public Accounting Report. He'll share his tips on building successful referral relationships with business advisors that, in many situations, clients trust most. Thanks, friends, and have a fantastic day.
Thank you for your time, everyone.